this video, we're going to share with you what happens when the world's largest sovereign wealth fund stress tests AI and the lesson that it shares in terms of the concentration risk. This video is going to be dedicated to Norway's 2 trillion fund quantifying what markets have long suspected. Let's first start with the stress test framework. Now, the Norges Bank Investment Management, which oversees the fund on behalf of the Norwegian Ministry of Finance, conducts annual stress testing exercises to assess portfolio resilience across hypothetical adverse scenarios. The 2024 iteration marked the first inclusion of climate-related shocks alongside the fund's traditional focus on macroeconomic and geopolitical risks. The exercise modeled 4 distinct scenarios based on the fund's December 2024 holdings. Now, each scenario assessed the expected shortfall by combining historical market responses to analogous stresses with forward-looking predictions. The results are striking in their hierarchy of severity. Now, the 4 scenarios are AI value correction, geopolitical fragmentation, debt crisis, and the climate shock, which is crop failure. The impact was seen in terms of the equity portfolio impact and the whole portfolio impact. When we are talking in terms of the AI value correction, the equity portfolio impact is minus 53% and the whole portfolio impact is minus 34%. When we are talking in terms of the geopolitical fragmentation scenario, the equity portfolio impact is minus 49% and the whole portfolio impact is minus 37%. Next, let's try and understand why the AI concentration dominates the risk hierarchy. Now, the fund's substantial exposure to technological equities explains the outsized AI scenario impact. As a largely passive investor tracking global market capitalization weighted indices, the fund holds significant positions in Microsoft, in Apple, in Nvidia, in Alphabet, Amazon, Meta, and Tesla, the cohort that has driven the majority of global equity returns since 2023. Now, this is not a Norway-specific phenomenon. Any investor benchmarked to the MCIS World and the S&P 500 faces structurally similar concentration. The top 10 constituents of the S&P 500 now represent approximately 35% of the index, a level of concentration not seen since the early 1970s. The difference is that today's concentration is thematically unified around a single technological paradigm. And next, let's talk about the fixed income offset, which is a partial hedge. An important nuance in the stress test results involve the fund's 30% allocation to fixed income. Under the AI correction scenario, the bonds would benefit to flight to quality dynamic, partially offsetting equity losses. This explains why the whole portfolio impact, which is 35% lower than the equity-only impact, which is 53% lower, and why geopolitical fragmentation with tariffs becomes the dominant risk when the bonds are included. The finding validates the traditional rationale for balanced portfolios. Equities and high-quality sovereign bonds tend to exhibit negative correlation during the risk-off episodes. So what are the broader implications for the AI valuations? The Norwegian fund stress test arrives at a moment of intensifying scrutiny around the AI-related valuations. Several dynamics warrant attention from the institutional investors. First and foremost, the revenue concentration versus the market capitalization. The Magnificent Seven's combined market capitalization now exceeds 17 trillion, yet the realized revenue from generative AI applications remains modest relative to those valuations. A Norwegian fund stress test disclosure offers several takeaways for institutional investors navigating similar concentration dynamics. First and foremost, the transparency itself is instructive. By quantifying scenario impacts, the fund creates a framework for governance discussions about risk tolerance and the potential mitigants. Asset owners with similar exposures might consider comparable exercises even if the results remain internal. Secondly, the limitations of passive indexing are becoming more apparent. Market cap weighting is efficient and low cost, but it mechanically increases exposure to the most richly valued securities. The alternative weighting schemes, for example, equal weight, factor-based, or fundamentally weighted indices, offer diversification benefits, although with tracking error and potentially higher costs.